Happy belated Valentine's Day, Airbnb family, Singles Awareness Day, if that's you. And either side of the fence, today's probably the Black Friday of chocolate sales, so enjoy that. Because it's so close to Valentine's Day, I want to talk to you about a very specific type of relationship in business: investor relations. There are a lot of you who've asked me questions about, taking on money from an investor, what those terms should look like, what are good terms for investment capital. Should you give them equity? Should you pay it like interest and debt? Just all sorts of stuff. So in this video, I'm going to talk to you about how to properly structure an investment agreement with somebody who's offering you money for your Airbnb business. My resume on the topic, I've been making money for about 10 years, like good investable income for about 10 years. My first $1 million business I built back in about 2011, 2012 is when we started breaking seven figures. And that's about when I started lending people money when they asked me for it for their businesses. I never got paid back on any of it. So I've lost about $250,000 on like ragtag investments to friends, friends of family, friends of friends, neighbors. And this is because I'm this hyper optimistic person who just believes that a handshake goes a long way. And that's actually not the truth. So in my 10 years of like scar tissue driven experience here, let me teach you how to protect yourself better. I'm gonna get your debt or your equity for the right price, because that's probably the most important part of this conversation. Let's go. Coffee is my second favorite way to get caffeine, as you all know. And yes, if for those of you who were wondering how my Valentine's Day went, I don't know, because I shot this before Valentine's Day and now it's after, but I am single. I wasn't for most of 2021, actually. I was pretty happy in a relationship. But it ended on good terms, no real crazy stuff on the way out. So nothing but gratitude there. So moving forward into 2022, I'm officially, again, married to the game. And this is my game, Airbnb, and teaching you Airbnb. So my first bit of advice, if I can bird's eye view this for you and then drop it down, my first bit of advice is you have to make a very clear decision on whether or not you want to raise debt or give equity when taking on money. And there's probably two very clear distinctions on path here. And by the way, I never ask you guys to do this, but when you subscribe, there is a bell icon, and I never ask you guys to click the bell. So for all of you current subscribers down there, check the bell to make sure your bell's on so you get my videos, just in case you don't, because that would suck if you didn't get my videos, and then I'd be even more sad than being single on Valentine's Day. So thanks. Now, if you're going to take on equity is something that you don't pay back, right? Somebody gives money into a business for a share of all future incomes because they have a share of your company. That can be the most expensive form of money you ever raise if you succeed. So I really only advise taking on equity if you're not sure, right? If you don't think you can make this happen or don't know with a certainty and you want to offset some of your own anxiety and risk, then yes, raise equity so that way you don't have to pay it back. Now, if you are certain of your business model, you have proprietary information, systems, like you're someone like me or a larger company, track record of success, don't give equity away, because you'll be promising away 5, 10, 15 years of profits, and that's extremely expensive. Even if you took some egregious hard money loan where your interest rate was like, say, even 25%. Well, if you're paying 25% over 5 or 6 years because it compounds, yeah, you're looking at, triple the money. You take in $250,000 and you pay $600,000 or $700,000 on the back end on that loan. But at the end of it, you get to keep pretty much everything after that, right? And in this world, Airbnb is so high margin, so high cash flow that if you take $250,000 in and you have 3 years to pay it off, you can actually flip $250,000 in this industry a few times, right? You can take it, get a bunch of furniture, get a bunch of leases, flip it 4 or 5 months later, do it again. You can flip $250,000 3 times in a year if you're good. Now, what that means is you've taken $250,000 and you've essentially invested $700,000 or $1 million in cash. So my second thing for you here is also to manage your expectations of what you need. You don't need a lot of money with Airbnb. If you're going to buy a property, then yes, you might need more money to buy properties, which means, having some equity firm buying real estate with you, and you maybe being this specialist that knows how to do Airbnb, and you kind of like work in tandem with them. That could be cool, right? Now, that's more of like a joint venture agreement, which is a third option. So that's where two parties come together and use mutual resources on the same project, and everybody keeps what they own already, And then whatever that project is, you guys agree on a profit split. So that is a third option for you there too. So let's continue the money ramble. You really don't want to take on equity unless it's like a long shot kind of deal. You don't want to take on too much debt because then you're paying off money that you would have never have used. So you really want to measure the amount of debt that you need. And I tell people, if you're a one-man band, right, you're a single person just trying to build a small business, it's really hard to put into play more than $25,000 efficiently. So if you take $25,000 now, you can pick up 4 or 5 apartments and then recycle that money over and over and over again. And you can take $25,000 and build a 30 or 40 or 50 door portfolio off of $25,000 of operating capital if you get front end concessions, get free rent on the front end like I teach you guys. You may not need a lot of money if somebody comes to offer you money. So don't take too much, don't get greedy, and don't give away equity. There are some unique deals that some people have approached me with where like somebody's like, they want to get into the Airbnb game, they're willing to buy the furniture, they want them to operate as an expert, and they're trying to come up with what the split would be. Well, I want you guys to be aware that co-hosting essentially is where a landlord who owns the property will buy the furniture and spend all of the money, right? The landlord is the full financier of everything. Then in exchange, the operator, if I was the co-host, and the landlord and I would come together, I'd be the expert in this space and I'd run it as a short-term rental on their dollar. Everything's spent by them. Even like if they have a Wheelhouse or Price Labs membership, that's on them too. Then we only deduct housekeeping from the top of line revenue. So if a house makes $6,000 and then $1,000 of it was housekeeping costs, we would write that off first and then we'd take our split. In normal co-hosting scenarios where I spent no money, I still get 25% of the $5,000 that's left. So, a little over $1,000 is mine, and then the other 75% goes to the landlord. So just under $4,000 is his. But then he has to pay the mortgage, pay the utilities, pay for Wheelhouse or Price Labs, pay for the supplies, pay for repairs. Be aware that co-hosting is a very standard agreement that exists in this world. So if somebody comes to you and says, hey, I want to do this deal where I buy the furniture and then we split it 50-50, well, if they mean revenue 50-50, take the deal because you're getting 25% of revenue in a regular co-host agreement. But if they mean 50% of profits, I don't think you should take that deal because you can't guarantee profit on a property. You just can't guarantee it. So if you're going to do a bunch of work and the property doesn't make money after expenses, right? Because the landlord's going to deduct the mortgage. They're going to deduct utilities, housekeeping costs, and whatever BS. He might even try to amortize his furniture into the deal and steal that from you, right? Before you guys split profit or whatever. Now your 50% of profit is going to be highly diluted if the property doesn't do well. Now, if it's gangbusters and the property's like operating expenses are $3,000 or $4,000 a month and you're pulling $20,000, then yeah, splitting 50% of the other like $16,000 is $8,000 for you. Where otherwise you would have only gotten $4,000 or $5,000. But that is a highly unlikely scenario to have such a low cost property perform so well. So if you take this kind of logic, I say that there's 4 aspects of running an Airbnb business. And if you are negotiating with an investor, keep this stuff in mind. Money is only 1/4 of the deal in a way, right? Cash to buy furniture and stuff is cool, operations. But deal flow, properties, getting the property is important as well. Then you have the labor, the manual, like blood, sweat, tears, setting the place up and operating it. But then 4th is the expertise and the know-how. The know-how drives revenue, drives margin. Right? So knowing what you're doing is just as important as the money. Having the property is just as important as operating the property. So if you are the expert operator, you have half of the deal, right? You have half of the equity. If somebody has a home and the furniture, then they have half of the equity, right? Or if they have the home and the money, then they have half the equity. If you guys came together on that deal, well, you should then in de facto get half of the property in equity because he's bringing the assets and you're bringing the operations and the expertise. Now, if you're brave enough to ask for that, right? All right, I want half of the assets and then I will do all of the work, right? You would make a deal on paper where there's something called a cliff, where your company would operate with that landlord for a series of years before you get your split of that asset equity. A lot of businesses do this where they bring on somebody like me to be, say, the CEO, and they want me to grow this company to some crazy size. Well, they're going to promise me 10% of the shares or 8% of the shares with something called an options pool, but they're not just going to gift it to me day one because I might take a hike. So there's something called a cliff. I will work for a year or two before I get access to my shares, the part of my compensation plan. So if you get ballsy and ask for what is really kind of owed to you, if you will make this argument, you can argue it with a cliff where the landlord is going to give you equity of his assets if you operate it, but only after like a couple or 3 years. Now, because I don't think landlords are going to be keen to sign on to that kind of deal, because landlords aren't business owners, VC capitalists kind of guys. They're not really signing up for stuff like that. It's just, I don't see it happening, but if you get the deal done, kudos to you. Because they're most likely not going to give you half of the value of their property to run it as an Airbnb, that's why things like co-hosting exist. And that's why you should factor in that what you get paid is considering that when they pay that mortgage, you're getting none of it. Right? So you need to factor more money to you than half, because when he pays the expenses, the mortgage, out of those expenses, he still makes profit on the expenses. You don't make profit on the expenses. You could propose an idea like this. You guys deduct housekeeping, you deduct all utilities, consumables, then you split it 50-50 and he can pay his mortgage from his 50-50 split. But if you're going to split profits, it'd be profits pre-mortgage. You should also protect yourself in the way that if you're the one doing all of the work and putting in all the sweat equity, you should have admin control of the property. You should be controlling the cash flow of the property and then paying out the stronger party. Because legally speaking, the stronger party can put the other one in the grave if they wanted to. And like legally speaking, not literally speaking. And so if the stronger party also had control of all of the money and you're living paycheck to paycheck off of breadcrumbs and the landlord owner equity guy screwed you over and stopped dispersing money from Airbnb to you and you went broke in the process of trying to get paid by him, you don't have the financial fortitude to come after him in court. So because you're the financially weaker party, you should be getting the handicap of control of the Airbnb account. If you do something wrong, then he can come after you in court and he's got a bunch of spare money. Right? Where now you have money to defend yourself because you've got the money. But obviously a weaker party usually should know better than to screw the stronger party in a contract. And that leads me to my next point. You should have a contract. Now, I'm not here to give you guys like literal legal advice on how to structure a contract, right? I'm not going to give you all the bullet points and terms, but I can tell you should have one. And not only should you have a contract, but you should have a basic understanding of the financial concepts at play here, like the cost of debt. If somebody's going to give you 10% interest, how does it compound? Right? If somebody's got equity in the deal, how are they making sure that they're getting their risk mitigated? Right? Are you offering them some form of preferred payout where they get the first percentage of revenues and then you get the next percentage or of profits or something like that? When somebody takes equity, they also want to have like a liquidity event where they can sell their equity for a big profit one day. And so these are things that need to be factored in. Somebody who's giving you debt, they don't care if you ever sell your company or not because their debt's going to get paid. It makes it a little bit cleaner. You don't have to justify why you're in business with a debt product. But you need to understand these types of things. So if you're interested in something like equity, look at a book called Venture Deals. And the back half of the Great Courses book I always talk about, Business Skills for Success, the back half talks about finance and stuff like that, enough for you to get going. There are also a couple of YouTube channels that are great for stuff like this. I mean, I love Wharton Business School's YouTube channel and Harvard iLab's YouTube channel. They talk a lot about venture capital, startups, taking on debt, stuff like that. They're teaching students how to start businesses. They are great YouTube channels to watch. And unsolicited advice near this topic, business partners. I think you should not have a business partner unless you absolutely need to have one. Don't have a business partner because it makes you feel good. Don't have a business partner because you need a cheerleader to kick your ass in the morning to go do some stuff because you need somebody to hold you accountable. That's not why you have a business partner. You have a business partner because you absolutely have no money or you absolutely have no skills when it comes to programming or code, and what you're about to build will require just a whole bunch of stuff like that. You're bringing on a business partner because their family is like related to Goldman Sachs and can get all the deals done on the back end because they've got skin in the game. Right? You strategically align with a business partner who brings something to the table that you don't bring. And if what they bring to the table is like ambition and business cunning, and that's it, you're going to get crushed because the cunning person is going to find a way to cut you out of the business. So if you are like easily led, right, and you don't have that independence, it is better to build slow and to grow up as a business person tend to bring somebody on that is capable of ripping everything that you ever dreamed to own from your claws because you don't understand business that well and you don't have the force of will to fight them in court to get it back. There are people who are very good at stuff like that. And you'd be surprised that people, when you want to see someone change, give them $1,000 that they owe you, right? You'll see social distancing real quick. When money's involved, people flip. So do not for a second ever think that you know somebody before you are invested into something with them. Because when it comes to money, people become maybe the worst versions of themselves. And I don't even follow this guy really, but I think Jordan Belfort says that money doesn't make you a better person. Money just makes you more of who you are. It's like being drunk is what he says. So if somebody's an asshole, money will make them more of an asshole, right? So think about it like that. So if you see some darkness in somebody, you see any red flags in somebody, you probably should not invest with them. There's another adage that I've heard from, I think it was Harvard iLabs, where they say that you can take good money from a bad investor. And having a bad investor who has partial control of your company or can tell you what to do is dangerous. Just like having a business partner, an investor with voting control and equity can rip a business from you too. And that's why Mark Zuckerberg kept all of the voting control of Facebook, even though there's all this money in there, is because he wanted to make sure that if he did something that the investors didn't like or didn't understand, that they weren't going to usurp him. And this was needed many times in the life cycle of Facebook. So guard yourself, guys. Plan for people to try to screw you out of business if you are invested with them or if you're partnered with them. It's better to go at it alone if you can. There are legitimate reasons to bring on a business partner, so I'm not saying don't ever do it, but do everything yourself until you can truly learn your power as a business person and you develop the will to fight and kill in the name of business, like figuratively kill another business person on the business battlefield. If you don't have killer instincts, an investor or a business partner is probably the last thing you'll ever want. So thank you for watching this video. Didn't mean to get dark at the end, but it's dog eat dog world out there. Remember, please like this video, share it with your friends, and I'll see you on the other side.